Hello, this is Steve Sanangelo once again from the SRSRockReport.com website. This is the YouTube channel. This is my newest video update, and it's an important one. It's on the shale oil industry's next victims, the major oil companies. Now, some individuals may say I'm exaggerating here, but I promise you, if you look at the data and the charts in this presentation, I believe you're going to come to the same conclusion. Now, if you've been following my work over the past several years, I've been focusing it on this, what I call the shale oil Ponzi scheme, and most of it has been on the small to medium-sized oil companies. And there's this notion that if these companies start to get into trouble, and they are, I'll show you in a minute, that the majors, which are like ExxonMobil, Chevron, and ConocoPhillips, they're going to come in, buy these companies for pennies on the dollar, and they're going to do a much better job. Well, I hate to tell you, if you look at the financial data coming from their reports, they're struggling to make money producing shale already. So I doubt that this is going to be a viable option moving forward. So let's get started. Now, as I mentioned, we're starting to see trouble, and we can always tell in the stock performance. Here we have Oasis, Whiting, and Concho. Now, this stock chart's a little bit old. It's about 3-4 days old, but if we look at this huge drop, this is when Whiting announced its Q2 earnings. Matter of fact, all these companies, all three had bad earnings. Whiting fell almost 40% that day. So in just the last month, Whiting is down 45%, Oasis is down 35%, and Concho 29%. Now, if the shale industry was still doing all right, humming along, we wouldn't see this kind of share price destruction. Well, I believe this is just going to continue, and it's going to spread in time to the other shale companies. And this is where I believe all of them, or most of them, are going to end up. I call it penny stock heaven. Now, Sanchez Energy, I wrote about several months ago, was trading at 18 cents a share. It's now closed at 2 cents today. It was trading at a high of 38 back in 2014. Over that 5-year period, it has lost 99.9% of its value. We can see it right here, according to stock charts. And wouldn't you know it, Sanchez has voluntarily filed Chapter 11, ironically, on August 11th. Here it says it follows an extensive review of strategic alternatives to align its capital structure with the continued low commodity price environment. Low oil prices, the company said in a news release. Now, this is the kind of CEO speak that they say to kind of bamboozle investors. However, the situation is really bad. Now, the Eagle Ford shale producer will continue to operate as usual with an additional $175 million in newly committed financing, of which $25 million will be used to repay borrowings and replace a letter of credit. Well, $25 million is a dent in the bucket. If we look at this next table, these are the shale E&P companies and shale companies that have gone bankrupt just this year. And here we could see at the bottom, Sanchez is the latest victim. Now, I said a drop in the bucket because Sanchez still has about 2.3 billion in total outstanding debt. Unfortunately, 1.75 billion, the most of it is unsecured. So how is Sanchez, now they borrowed another 175 million, how are they going to pay back this 2.2 billion in debt when they haven't been able to, they're still losing money. So this is what I see moving forward. These small to medium-sized shale companies are going to continue to deteriorate, and that is just going to be bad news for the whole industry. So now, if we look at the majors, we're switching now to the majors. The best way to see what's happening with the majors, we have to go before and then after shale. And the best way I found out was to go to 2005. Now, the shale oil started to take off in the U.S. about 2007, 8, 9. And I chose 2005 because the price of oil was like $56.60 in 2005 a barrel. And in the first 6 months of this year, it was a little bit more than 57. So the price of oil was about the same. Now, here we've got ExxonMobil, Chevron, ConocoPhillips, and I'm only looking at ConocoPhillips lower 48 states. ConocoPhillips produces a good bit of oil in Alaska, as well as they have some good earnings. So I wanted to remove that from this equation. I could not do that with Chevron or ExxonMobil, but I do believe ConocoPhillips has a larger percentage of oil of the three in Alaska. Either way, what we see, ExxonMobil back in 2005 earned $6.2 billion in its upstream earnings, and those are its oil and gas wells. Chevron, $4.1 billion, and ConocoPhillips earned $1.7 billion. Now here is what they spent, their CapEx, capital expenditures on their U.S. oil and gas wells. ExxonMobil spent $2.1 billion, Chevron $2.4 billion, and ConocoPhillips $891 million. So what we could see is they're earning a lot more than they were investing in capital expenditures. And we could see that in their international or non-U.S. sector, that I'm not going to get into too much detail, but we could see that they were earning, in most cases, more than they were spending on their capital expenditures on their oil and gas wells in their non-U.S. sector. But something changed. Now let's fast forward to today. Now that these companies are getting into shale, ExxonMobil has spent $5.8 billion on its U.S. oil and well capital expenditures in just the first 6 months of the year. But look at their earnings, $431 million. Now, Chevron is actually doing better. It's doing better than the three. It earned $1.6 billion in its earnings in its oil and gas wells in the U.S., but it did spend $3.8 billion, almost more than double. And here we could see ConocoPhillips in its lower 48 states. It spent $1.77 billion on capital expenditures, and it only earned about $400 million. Now here is the non-U.S. in the same period in their international sector, but we could see that what they spent, at least they're earning. But we have to remember, these three companies are headquartered in the United States, and they're spending so much more money investing in their U.S. oil and gas wells, but their earnings are not that well. So I wanted to move to ExxonMobil and focus on ExxonMobil because it's underperforming the group. It's the worst performer, and ExxonMobil is the larger oil company. So if we look again, in 2005, ExxonMobil made $6.2 billion on its oil and gas wells. It spent $2.1 billion on capital expenditures on those oil and gas wells. But now, fast forward to today, it's $5.8 billion in capital expenditures, only to earn $431 million. But I wanted to show you this because this is important. The oil price, according to the EIA in 2005, was $56.64 a barrel. So in 2019, it's higher. They're getting paid a little bit more, but this is the key number to look at. ExxonMobil, its average oil production in the first half of the year was 631,000 barrels a day, compared to 477,000 barrels a day in 2005. So Exxon is spending a lot more money. The production is much higher than it was in 2005. They're getting a little bit more money per barrel, and look at the earnings. It's a disaster. Now, I wanted to go through these tables really quickly just to give you an idea of where I've got this information. I just didn't get it out of thin air. I've got ExxonMobil's data from its 2006 annual report I had on file, and it shows 3 years, so we could see its upstream earnings in its U.S. oil and gas wells, $6.2 billion, capital expenditures, $2.1 billion, produced 477,000 barrels a day in 2005, net production of crude oil and natural gas in the U.S. Fast forward to today, in the second quarter 2019 report, ExxonMobil earned $96 million in the first quarter, $335 in the second, for a total of $431. But here, their capital expenditures in their U.S. oil and gas wells back in the second quarter of 2018, we could see it's almost double. It's increasing rapidly to $3.2 billion in the second quarter, but look at the earnings. They're almost 10 times less. And then this last table shows you the production in the U.S. for ExxonMobil, 600,000 barrels a day in the first quarter, and 662 in the second quarter for an average of 631,000 barrels a day. So again, ExxonMobil did pretty well, 6.2 billion in 2005, and its capital expenditures were about a third. Now we see the capital expenditures are almost 3 times higher, and this is only half the year. I'd imagine that ExxonMobil is going to spend close to 10 billion, almost 5 times what it was in 2005. But here, look at the earnings, 431 million. Now, what I did is I took that information and put it together for all three to compare the U.S. and non-U.S. or the international. So ExxonMobil, Chevron, ConocoPhillips earned 2.4 billion in the first 6 months of 2019 on their U.S. oil and gas wells, but they spent 11.4 billion on capital expenditures. The total production of these three in the U.S. is 1,660,000 barrels a day. Now let's compare that to their non-U.S. or international sector. They earned 12.7 billion on their international oil and gas wells in the first half of the year. They spent less, 11.3 billion, and the production's almost double, 3.2 million barrels a day. Now these next two charts say it all. I put it all in these next two charts. What I did is I took all the earnings of these three companies back in 2005 and in the first half of 2019, divided it by their oil production. And these three companies earned $32.48 per barrel in 2005 and only $8.20 in the first half of 2019. And the majority of that was from Chevron. Now, their non-U.S. or international sector, they earned $21.24 in 2005 a barrel and increased a little bit because the oil price has gone up. They earned $22.04 per barrel in 2019. So in this period before and after shale, their earnings per barrel increased in the international 4% right here. But in the United States, it plummeted 75% in the same period. Now, the next chart shows you their capital expenditures per barrel. And all I did is took their total capital expenditures of these three and divided it by how much oil they produced that year. And in 2005, they spent $14.71 per barrel on their oil and gas wells in the U.S. Now they're spending $37.86 per barrel in the first half of this year. Now compare that to their international, where over the same period, it's increased about $3. So in before and after shale in the international sector, these three companies' capital expenditure per barrel has increased 18%. But in the U.S., it's up a staggering 157%. So if we go back, these three companies, their earnings per barrel in the U.S. sector is down 75% since they got into shale, and they're spending a stunning 150% more per barrel on its capital expenditures. So what does this mean? In conclusion, I believe just like what we saw with BHP Billiton, which is a mining company, they invested heavily into shale starting in 2011. Now, after a while, it became a disaster for them. And their large shareholders told management, you need to get out. So they started selling assets. And I believe BHP Billiton has sold their last shale assets to BP, I think just this last few weeks. So we're going to see the same thing happen with the majors. I do believe you're going to see major shareholders of ExxonMobil, and someone, if you know anybody, please forward in this video, that in time, they're going to tell the management of ExxonMobil, stop trying to ramp up production of shale because they're not making the money. So going forward, we're going to see more deterioration in the small to medium-sized shale companies. It's going to get worse in the majors. And in time, I believe that the major oil companies are going to start pulling back because they're just not making the money. So I want to thank you for watching my newest video update. If you have not yet subscribed to the SRS Rock Report YouTube channel, please consider doing so. And also, I would appreciate if you would consider supporting the SRS Rock Report YouTube channel or the SRS Rock Report website.com. And if you can, at PayPal or Patreon. Thank you very much.